Welcome to Tech Money Madness, your daily U.S. stock market podcast, June 16th, 2026. We're really glad you're here with us for this deep dive because, well, 150 years of stock market history is currently flashing a warning signal. And it's a signal that has only appeared twice before, once today, and once at the absolute peak of the dot-com bubble back in 1999.
Yeah, it's wild to see it happening again in real time.
Yeah.
Because underneath this seemingly quiet surface today, I mean, the S&P 500 started completely flat, and the Dow is just sort of riding a bit of its recent momentum.
Right.
But beneath that calm exterior, we are seeing some extreme mechanical shifts in where capital is actually flowing. It's really changing what the future of our infrastructure is going to look like.
It really is. But before we get into the gears of those shifts, just a quick note for you listening, we are going to touch on some major market drivers today that involve, international relations with Iran, regulatory clashes over in Europe, and even domestic safety nets like Social Security. But our goal today is strictly analytical. We're just looking at the data, the financial mechanics, and how this actually moves the market. We aren't taking any political sides here or passing moral judgments.
Exactly. We're just reading the instruments on the dashboard.
Yeah. So let's look at the most glaring instrument on that dashboard today. Okay, let's unpack this. The cyclically adjusted price-to-earnings ratio, the CAPE ratio, has just crossed 40.
Yeah, 40. What's fascinating here is, well, like you mentioned, we have a century and a half of market data.
Right.
We've seen world wars, industrial revolutions, periods of massive inflation. And through all of that history, investors have only been willing to pay this kind of premium once before.
In 1999. So for the listener who might not check this metric every day, why is crossing 40 such a massive deal?
So to understand why that number is so stretched, we really have to look at the mechanism of the CAPE ratio itself. I mean, a standard price-to-earnings ratio, it just looks at a company's profits over the last 12 months, right? But one genuinely great year of earnings, or, one terrible year, can completely skew the picture. The KPE ratio smooths that out.
Because it takes a longer view, right?
Exactly. Take a 10-year average of earnings, and it adjusts them for inflation. So it really tells us the fundamental cost of the stock market compared to the actual historical cash those companies have proven they can generate over a long period.
Got it. I'm picturing like an airplane climbing at an incredibly steep angle. The pitch of the nose is the CP ratio, and it's pointing straight up at 40.
That's a great way to think about it.
The market is gaining altitude rapidly, but you run this mechanical risk of an aerodynamic stall if the engines, which would be the actual corporate earnings, don't generate enough forward thrust to catch up to that aggressive pitch.
And in 1999, the engines stalled. I mean, the internet obviously transformed the world, but it took a full decade for the actual corporate cash flows to catch up to those crazy 1999 valuations.
Which brings me to my big question. Is this just an irrational 1999-style bubble about to pop? Or is the actual technological leap we are seeing right now justifying suspending our disbelief in gravity?
Well, the market today is making a similar massive structural bet. It is actively pricing in a future that just hasn't fully arrived yet. But, and this is the key difference, the capital isn't flowing into some generic internet concept anymore.
Right. It's much more specific now.
Yeah, it's flowing directly into the mechanics of a post-smartphone future.
And we see that vividly in the specific market movers today. I mean, Snap just unveiled a pair of augmented reality glasses priced at, get this, $2,195.
Oh, wow.
Yeah, that is a massive capital allocation towards spatial computing. And then you look at Qualcomm, whose stock jumped 4% in pre-market trading, which made it one of the top gainers today.
Yeah, and the catalyst there was their CEO announcing the development of over 40 AI-powered devices. 40.
Which is just a staggering number to drop all at once.
It is. The mechanism here is a complete hardware replacement cycle. For the last 15 years or so, the smartphone has basically been the bottleneck for the global economy.
Yeah, pretty much all value flowed through a 6-inch screen.
Exactly. The screen and the app stores that controlled it. What Snap and Qualcomm are doing is trying to physically bypass that bottleneck. If spatial computing and ambient AI actually take over, the economic value capture moves away from software subscriptions and flows back to the physical hardware ecosystems.
Right. So when investors see a headline like 40 AI devices, they aren't just looking at Qualcomm's profit margins for next
No,
quarter.
no, not at all.
They are pricing in the probability that every human on Earth will need to buy a completely new suite of devices to interact with the world over the next 5 years.
Exactly. I mean, think about it. Look at the smartphone you are probably holding right now or, sitting next to on your desk as you listen to this. What stands out to you about a transition to a post-smartphone world driven by AI and AR?
It's a huge shift. It's massive. The market is betting trillions of dollars that within a very short time frame, that piece of glass will be a total relic. That SAPE ratio of 40, that's the premium investors are willing to pay today to own the companies building the replacement.
But to power that post-smartphone future, you need ubiquitous, low-latency data anywhere on Earth. I mean, a headset rendering real-time AI can't just rely on spotty cellular towers.
Right, you need infrastructure.
Which brings us to the company building that literal infrastructure in orbit. And this is the biggest, most undeniable tech story of the day. SpaceX's stock surged 4% today, catapulting its market capitalization to $2.75 trillion.
It's just unbelievable numbers. SpaceX has officially leapfrogged Amazon to become the fifth most valuable company in the world.
Wow. Past Amazon.
Yeah, they're sitting right behind Microsoft now.
Which completely redefines what a tech company even is. I mean, they aren't building a social network or an ad platform. They are building a literal logistics network for low Earth orbit, and they are one of the most actively traded stocks of the day by volume. The valuation mechanism for SpaceX is fundamentally different from a legacy software company. Investors are looking at their Starlink satellite internet constellations, their reusable rocket cadence.
Right.
And they realize SpaceX is basically creating a monopoly on the infrastructure of the future economy. If the post-smartphone world requires continuous global connectivity, SpaceX owns the toll road.
But here's where it gets really interesting today. While SpaceX is literally soaring and defining this new infrastructure, the companies that built the current infrastructure, specifically Apple and Google, are sitting on today's top losers list.
Yeah, they are hitting the wall of digital sovereignty in Europe.
Okay, digital sovereignty. Because I look at the legal frameworks Europe is throwing at these American tech giants, and to me, it looks like a physical border dispute, just playing out in the digital realm.
That's a really good way to put it.
Because for 2 decades, Europe effectively outsourced its digital life to California, and now they are actively forcing a decoupling.
If we connect this to the bigger picture, the mechanism of digital sovereignty isn't just about, handing out fines for antitrust violations anymore.
Right, it goes way deeper than that.
Much deeper. Europe is aggressively deploying regulations that mandate local data centers, force open software ecosystems, and require interoperability.
They are physically forcing American tech giants to dismantle their walled gardens within European borders.
Yes. The goal is to artificially create oxygen so that European domestic infrastructure and their own equipment suppliers can actually survive and compete.
So we aren't just looking at standard antitrust stuff. Are these giant U.S. tech companies basically acting like modern nation states, and we're just watching a turf war between them and actual sovereign nations in Europe?
Basically, yes. I mean, Apple's market cap dwarfs the GDP of most countries.
Yeah.
They dictate privacy policies that affect billions of people. They control the flow of commerce through their payment systems. They effectively control the modern town square.
Sure.
Europe is a sovereign entity, realizing it lost control of its own digital territory. And it's using the only weapon it has left, the regulatory power over its 450 million consumers, to force a treaty.
And the market is aggressively pricing in the reality of that treaty today. Apple and Google's revenue exposure in Europe is massive. If they're forced to surrender their monopoly margins to comply with these digital sovereignty laws, the financial math for those legacy giants changes practically overnight.
Exactly. It's a huge headwind for them.
Now, while sovereign nations in Europe are using regulation to control their borders, global powers and central banks are actively pulling the massive levers of the macroeconomic engine to control the broader environment.
Right.
Let's look at the foundational pillar of that environment: energy. The U.S. has officially reached a deal to allow Iran to sell oil immediately.
And the financial mechanism triggered by that announcement was just instantaneous. Global oil prices have tumbled today to a 3-month low.
Wow.
Yeah, and that's placed oil-related stocks right next to Apple and Google on the top losers list today.
It's crazy because we are seeing futures contracts react before a single new barrel of oil is even pumped.
Exactly, because the oil market operates entirely on marginal supply. When the U.S. suddenly unlocks millions of barrels from a major global producer like Iran, traders instantly reprice the futures contracts for cargo ships that are already out on the water.
The projected scarcity just vanishes.
Exactly. It vanishes.
And from a macro perspective, that sudden influx of cheap energy is a massive deflationary force. Every factory pays less for power, every shipping company pays less for fuel, and consumers end up with more discretionary income at the pump,
Yep.
which directly impacts the entity whose entire mandate is managing that inflation for the Federal Reserve.
Right. And we have crucial updates on the Fed's posture today, too.
What are we seeing there?
Well, the CNBC Fed survey respondents expect the Fed to remove the easing bias from their official statement. And on top of that, Fed Chair Warsh is expected to withhold the dot from the central bank's interest rate outlook.
Okay, let's translate that central bank jargon for a second. Withholding the dot. The dot plot is essentially the Fed dropping breadcrumbs for the market, right?
Yeah.
Showing where individual officials think interest rates will be over the next few years.
Right, exactly. So by withholding that specific forward guidance, Chair Warsh is effectively stopping the trail of breadcrumbs.
Meaning they don't want to commit.
Right. Mechanically, the Fed is refusing to lock itself into a promised path. They're demanding maximum flexibility because the data coming in is just too volatile right now.
So for the market, withholding the dot translates to an expectation of absolute inertia. Rates are staying exactly where they are for the foreseeable future.
Precisely.
And what about the removal of the easing bias? What does that mean in plain English?
So the easing bias is basically the underlying tone of the Fed's communication. For months, the language implied their finger was sort of hovering right over the rate cut button.
Like they were itching to do it.
Right. So removing that bias means the default setting is no longer, "we will cut soon." But ironically, plateauing at this currently high level means that whenever the inertia finally does break, the next mechanical move in the cycle is still highly likely to be a cut rather than a hike.
It's a posture of stable vigilance, basically.
Exactly. Just waiting and watching.
We have one final macroeconomic variable today, and it involves the domestic safety net here in the U.S. The Penn-Wharton budget model just released an updated forecast for the depletion of the Social Security Trust Fund.
Yeah, this is a big one.
They are projecting the retirement trust fund will potentially dry up in February 2033. Now, strictly looking at the numbers, this actually pushes the depletion date slightly later than previous official government projections.
Yeah, and to understand why this matters to the broader market and not just retirees, we have to look at the mechanics of the trust fund itself.
Right, because it's not what people think it is.
No, not at all. It isn't just a giant vault sitting somewhere filled with cash. The Social Security Trust Fund holds special issue U.S. Treasury bonds. It is essentially an accounting mechanism where the government owes itself money.
So when the Penn-Wharton model says the fund depletes in 2033, it means that accounting mechanism runs out of surplus. To keep paying retirees their full benefits, the U.S. Treasury has to go out into the open market and issue massive amounts of new public debt to cover the shortfall.
And that is the mechanical link to the stock market. Because if the government suddenly has to flood the market with trillions of dollars in new bonds in 2033, it absorbs a massive amount of liquidity from the system.
It drains the pool.
Yeah, it can drive up bond yields, which directly competes with the stock market for investor capital, and it severely limits the Federal Reserve's flexibility. It's essentially a demographic time bomb built directly into the bond market.
So what does this all mean? Let's bring it all together. We have a market where the SAPE ratio is pointing the nose of the plane straight up at 1999 bubble territory. Snap and Qualcomm are trying to force a global hardware revolution. SpaceX is becoming a multi-trillion-dollar monopoly in orbit. But down in the engine room of the economy, we have cheap Iranian oil flooding the supply chains, the Fed basically freezing the interest rate dials, and a massive bond issuance cliff waiting for us in 2033. How do these macro forces combine to sustain this level of technological exuberance?
Well, they combine to create an artificially stable atmosphere. Think about it. The cheap Iranian oil acts as a massive dampener on global inflation. Because energy costs are artificially suppressing that inflation, the Federal Reserve doesn't actually have to panic.
They can just chill.
Exactly. They can afford to sit back, withhold the dot, and hold interest rates perfectly steady.
The engines aren't overheating.
Precisely. A stable, non-inflationary environment with plateaued interest rates is the exact oxygen high-growth tech companies need to thrive.
Right.
Capital managers look at that steady macroeconomic landscape, and they feel totally safe taking massive long-term risks on the future. They feel perfectly comfortable paying a keep ratio of 40 for a post-smartphone ecosystem because the underlying tectonic plates of the economy, oil and interest rates, are basically locked in place. The cheap energy and the steady Fed create the perfect launch pad.
It really is a day of intense contrasts. We are looking at a daily market briefing completely split between the limitless ambitions of space infrastructure and AI hardware, and then the very rigid earthly constraints of sovereign European borders, oil futures, and central bank ledgers.
Yeah, it's the ultimate tension between the deployment of next-generation capital and the physical realities of the current world order.
It really is. And, if the Penn-Wharton model is right and the Social Security Trust Fund hits a mathematical wall in 2033, requiring a massive restructuring of government debt, consider this. Will the real safety net for the next generation actually be government policy?
That's the big question.
Or will an entire generation find themselves entirely reliant on the AI productivity and technological dividends created by the very companies reaching these stratospheric valuations today? We're looking at a market hitting heights we haven't seen since the dawn of the consumer internet. But with regulators fighting for digital sovereignty and central banks holding the levers of capital so tightly, when the history of the 2020s is written, will we remember this as the era where technology finally outgrew the nation state, or the era where the nation state finally reeled technology back in?
Well, yeah, it's something you really have to think about.
That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.